Good evening. It is my great pleasure to introduce John Graham, President of the American Finance Association. There is so much to be said about John, and I have so little time that this will only be a brief introduction. Before talking about John's many accomplishments, let me start by telling you a few things you may not know about John. First, he has long been serious about athletics and really involved in sports, from lifting weights to bike riding to playing basketball and volleyball, to even spending years coaching youth sports for his 3 children. Second, John believes in giving back, both to the community and to the academic profession. For example, he founded the Fuqua chapter of Rise to Hunger, an international organization that provides meals and other support to struggling communities. As this picture shows, many gather at Fuqua to pack meals, and over the last decade, the faculty, staff, and students have packed almost 500,000 meals. While president of the FMA, John founded DESI, the Diversity Emerging Scholars Initiative Mentoring Program, which is helping many junior faculty. Finally, what you may not know, but I particularly enjoy knowing, is that John is a native Texan, having been born in Texas. Now, for a very brief presentation of John's professional accomplishments. Instead of one PowerPoint slide, this could be a mini slide presentation because there's so many of these accomplishments. John is a D. Richard Meade Professor of Finance at the Fuqua School of Business, Duke University. He spent 6 years as co-editor of the Journal of Finance, and he is presently president of the American Finance Association. And he has served in many additional roles on behalf of the organization prior to this year. He has also contributed his services to being president and officer of other academic associations. John has long been the director of the Duke CFO Global Business Outlook Survey, which has provided many insights into corporate views of the current and future business environment. John is truly an award-winning researcher, having been honored with over 23 research awards, including winning the Bradley Prize for Best Corporate Finance Paper in the Journal of Finance and winning 5 times the Jensen Prize for Best Corporate Finance Paper in the Journal of Financial Economics. And there are many other awards as well. His work has been highly important for different areas in finance, as shown by his over 50,000 Google Scholar citations. I would like to talk about specific areas in which John has made valuable contributions. The first is his work on corporate taxes, particularly the relationship between taxes and debt policy. For example, in his papers, How Big Are the Tax Benefits of Debt, published in the Journal of Finance, and Debt and the Marginal Tax Rate, published in the Journal of Financial Economics, John shows the persistence of managers' conservative debt policy, as well as how a firm's debt choices are related to simulated firm-specific marginal tax rates. This work and much subsequent work has helped us understand how taxes can influence corporate debt decisions, not only in managers' conservative debt choices, but also in how other mechanisms such as tax shelters, macroeconomic conditions can affect the debt choices. Moreover, John's research is not just highly important in the academic literature, but also has had significant effects on finance practice. For example, his simulated marginal corporate tax rates are regularly published in industry publications. In John's work with Hanlon, Shevlin, and Schroff, published in the Accounting Review, Incentives for Tax Planning and Avoidance, Evidence from the Field, he finds that managers' incentives have apparently strong effects on their tax choices. This paper also combines another area in which John is a top researcher, a leader in the field, which is surveys, and in particular, surveys of corporate executives. These surveys have provided valuable context for our understanding of both the thinking and actions of the executives, which has informed many theoretical and empirical papers by subsequent researchers. The surveys have been not only informative about managerial decisions, but because of the ways in which John and his co-authors have cleverly designed the surveys, we gain insights into managerial behavior that we might otherwise not have understood as well, including the existence of agency problems. For example, in the most highly cited of the survey work, The Economic Implications of Corporate Financial Reporting, co-authored with Cam Harvey and Shiva Rajgopal, the authors provide the striking result that managers would avoid initiating positive NPV projects if it meant falling short of the current quarter's consensus earnings. Beyond the survey research, John's work has also taught us much about corporate finance issues. And these are included as well in his survey research, such as cost of capital, capital structure, financial reporting, payout policy, and corporate risk management. I could continue to go on and on about all the work that John has done and his many accomplishments, but I'm sure you're ready to hear what new insights John's presidential address will bring us. I know I'm certainly looking forward to it.
Thank you, Laura, for that introduction. Let me also take this opportunity to thank my family, especially my wife, Suzanne, for many years of support. Today, I'll talk about corporate finance and reality. In financial economics, we have a long tradition of building models based on simplified assumptions in an attempt to predict and explain economic outcomes. In the context of corporate finance, we've learned a lot and we've identified key economic trade-offs. And yet a gap exists between academic research and the real-world practice of corporate finance. This gap is reflected in the modest statistical fit of our empirical models in explaining outcomes. For example, most empirical models of capital structure explain only about 10% of within-firm variation and can explain even less out of sample. In this paper, I'll use CFO surveys in an attempt to address this gap between the academic research and the practice of finance. Now, in corporate finance, we have a unique advantage in that we can talk directly with the experts who choose the outcomes that we study, to ask them about both the outcomes and the decision processes that drive the outcomes. In this spirit, I use CFO surveys to gather information that can be broadly described as stylized facts about how CFOs choose investment, capital structure, payout, and other corporate policies, and unifying themes or common elements of the decision process that cut across policies and that also hold through time. Understanding these details about the practice of finance is helpful in many ways. When academic models align with outcomes, this information helps us to interpret actions and understand mechanisms. When models and practice do not align, knowing how outcomes are chosen and what CFOs optimize can help to guide and discipline models, always with the goal of better predicting and explaining outcomes. One way these unifying themes may help is by providing a wider range of assumptions that can be used to enhance traditional models or possibly build new models based on a set of more realistic assumptions. These facts and themes may also be of independent research interest, exploring issues such as determining the underlying forces that cause the unifying themes of the practice of corporate finance, as well as studying how these facts and themes drive the policy outcomes that we study. Of course, when I mention modeling assumptions, you might naturally think of Milton Friedman, who argued that if a model's predictions are successful, then it's not really important whether the model's underlying assumptions are realistic. However, the relatively modest ability of our models to explain outcomes, especially out of sample, weakens the as-if argument in a corporate finance setting. In addition, to narrow the gap between theory and practice, it's important to understand both cause and effect, which the as-if perspective sidesteps. The CFO survey data that I collect for this project is gathered primarily through a two-part survey that directly asks CFOs about corporate decision-making and outcomes. The two primary surveys occurred in March of 2019 and March of 2020. Today, I'll refer to these surveys jointly as the 2022 survey because this paper will be published in 2022. It's important to note that almost all of the information we'll discuss today was gathered pre-COVID. So for the most part, we can set COVID aside as we work through the analysis today. Each of these two new surveys contains about 500 responses from the United States, with a few dozen also from Canada. I'll also compare to other surveys conducted over these past 25 years including those conducted with my colleagues Cam Harvey, Alon Brav, Ronnie McKiley, and Manju Puri. One type of information these new surveys gathers relates to corporate expectations and planning, that is, companies' internal plans and scenarios. This analysis is somewhat new to corporate finance, and yet, if you think about it, planning underlies many of the corporate decisions that we study. The planning process leads to the cash flow forecasts that drive many other decisions, and so understanding corporate planning and integrating it into our corporate research is important. The planning analysis contains both a before and an after component. The before part asks CFOs in early 2019 to forecast revenue, capital spending, hiring, and about 10 other variables for the year 2019. The after component asks CFOs in early 2020 about the realizations for 2019. This allows me to determine forecast errors and to ask CFOs what caused the error and how in response companies changed real decisions and future forecasts. As I mentioned, planning underlies the decision-making of other corporate policies. Planning produces revenue and cash flow forecasts that drive corporate investment decisions, which in turn are connected to capital structure and ultimately to payout. The surveys gather detailed information about each of these policies. As you might notice, this policy information harks back to Graham and Harvey, as well as some of the other CFO surveys we've conducted at Duke over the past 25 years. This enables me to compare the practice of finance today to the practice 2 decades prior, and this comparison yields some interesting findings, as we'll talk about later. For the rest of today's talk, I'll start on the next slide by describing the common elements, that is, the unifying themes of real-world corporate finance. As we proceed, I'll also present a subset of the stylized facts of the practice of corporate finance as it applies to planning, investment, capital structure, etc., in order to show you how the common themes emerge. I'm only presenting a subset of policy results in the interest of time, but in the paper itself, you can find detailed descriptions of the practice of finance with respect to a number of corporate policies. My hope is that these descriptive facts and unifying themes provide individual topics for future research and collectively guide and discipline academic models and tests to improve our ability to explain and predict real economic outcomes and to help us close the research practice gap. Now, let's talk about the unifying themes. The first unifying theme of corporate finance is that many corporate decisions have a near-term focus. I'll provide more details as we go, but specifically, when I ask CFOs how far into the future the information in their corporate plans is reliable, they say about 2 years. They may create a 5 or a 10-year plan, but CFOs feel the information is only reliable for the first couple years. The second theme is that if we analyze the forecasts that managers produce, we see they are miscalibrated. By miscalibrated, what I mean is the distributions of their forecasts are too narrow. That is, the tail of the distribution, they're not fat enough. Consequently, realizations occur in the tails much more often than expected. In the paper, I particularly focus on frequent negative surprises that companies experience. So, if you have corporate plans that are only reliable for a year or two, and companies often experience negative surprises, how might we expect corporate policies to be designed? Well, relative to a well-calibrated, rational world, we might expect that corporate policies would appear to be conservative, the third theme. And this is exactly what we find, in that many corporate policies do in fact appear to be conservative. Again, more details to follow. The fourth unifying theme is that many decision processes are sticky or slow-moving. What I mean by that is if you compare the practice of finance in 2001 to practice today, you see that decisions today are made in a very similar manner to the way they were made 20 years ago. Thus, the decision processes appear to be very stable. Fifth, many corporate policy decisions rely on simple decision rules. Finally, managers often try to time the market, and in fact, most managers, in most years, believe their firms are undervalued, which provides incentive for market timing behavior. These themes collectively describe important elements of real-world corporate finance. My hope is that future research will integrate these themes into our models and empirical analyses. Now, I just mentioned about a half dozen themes, and soon I'll share with you some descriptive facts. It might help if we had a framework to organize our thinking and keep track of findings. One thing we could do is modify traditional frameworks, for example, by incorporating costly biases. Jose Barrero does just this in his dissertation, incorporating miscalibration and another theme into an otherwise traditional structural model that examines employment and valuation. Bolton, Wang, and co-authors have a series of papers where they also integrate various aspects of the themes into their models, as do other authors. Alternatively, we could adopt a non-traditional approach. For example, the satisficing behavior paradigm of Simon as follows. The world is complex and fast-changing. Companies can only reliably plan a year or two into the future. Managers are miscalibrated, and so they frequently experience negative surprises, and they use simple, conservative, sticky decision rules. In such a setting, it's difficult to precisely optimize in a traditional way. In fact, it seems more likely that managers take a step in the right direction as they strive for incremental improvement. So rather than any sort of a global long-run optimizing, they strive for one step at a time incremental improvement. And in this environment, simple conservative decision rules might work as well as any in determining this next step and keeping more options open for the future. Furthermore, if a decision rule works well enough, then stick with it. By way of analogy, let's say you just entered a dark room and the door closes behind you. There's a faint light over in the corner of the room. To move towards that light, you take one step at a time and proceed cautiously as you attempt to incrementally get closer to the light. If the step just taken seems to work well enough, you likely repeat that process as you again try to take another incremental step of improvement. This, I think, is a reasonable description of how many corporate decisions are made. And in this incremental, satisficing perspective, it encompasses many of the unifying themes of the practice of corporate finance. For the rest of the talk, I'll discuss results for several different corporate policies one by one. I'll start with corporate forecasting and planning, then proceed to investment, capital structure, and the other topics. As I do that, I'll emphasize the unifying themes that cut across these policies and that also hold through time. In the process, I'll highlight a few stylized facts, but there's much more information in the paper that I don't have time to get to today. One key fact is financial flexibility is paramount. Another interesting issue is whether or not investment and capital structure are interest rate sensitive. The paper also addresses which state variables drive corporate investment. We'll also discuss which variables and objectives companies attempt to optimize, even if it is one step at a time improvement. So let me get started by first talking about corporate expectations and internal plans. You can see from the bullet points that there are a number of different topics covered in the paper. I'm only going to talk about 3 right now. First, briefly, CFOs say that revenue forecasts are the most important forecast on which to deliver, indicating the importance of sales growth among corporate objectives. Now let me talk in some detail about the first 2 bullet points. This slide repeats in abbreviated form the 6 themes of the practice of corporate finance. Today's discussion of expectations and planning will highlight the first 2 themes, which are shown in bold. In particular, we'll talk about near-term focus and about how managers are miscalibrated. I ask CFOs how many years into the future they feel the information they use in their corporate plans is reliable. As shown in blue, CFOs say that the information in internal forecasts is reliable about 2 years into the future. As a reminder, this is a pre-COVID survey question, as are most of the results we'll discuss today. When I asked these same CFOs how reliable their information was 5 years earlier, they said their planning information at that time was reliable 3 or 4 years into the future, as shown in orange. So within this 5-year time frame, their reliable planning horizon shrunk by a year or two. Now to clarify, most companies create a 5 or a 10-year plan. However, CFOs say the information in these plans is only reliable about the first 2 years into the future. This is what I mean when I say that company plans have a near-term focus. This near-term focus of corporate planning is of interest in its own right, and it undoubtedly affects other corporate policies too. For example, a short-term planning horizon may affect the type of investment project that a company undertakes. I ask these same CFOs what the horizon is for their typical new investment projects, with today again shown in blue. As you can see, they indicated that the horizon of projects they are undertaking has also shrunk over this 5-year period, again shrinking by a year or two. And so we see that the short planning horizon is connected to the horizon of real investment projects. To clarify, I'm not saying that this short investment horizon is suboptimal. In fact, it may be perfectly optimal given circumstances. Nor am I saying that firms invest too little, though both of these issues are worthy of future research. What I'm saying is that the short planning horizon seems to affect the horizon of other corporate decisions, such as investment. The second theme is that managers are miscalibrated. What this means is their forecast distributions are too narrow. On the survey, CFOs provided a 10th percentile, a best guess, and a 90th percentile sales revenue forecast. If managers are well calibrated, we'd expect that about 10% of realizations would fall at or below the 10th percentile forecast, and likewise above the 90th percentile, as shown in the black boxes on the slide. Instead, at the far left, we see that nearly 30% of realizations fell below the 10th percentile. This is an indication of miscalibration, and it leads to the frequent negative surprises that I mentioned earlier. That is, companies experience realizations in the tails of their distributions more frequently than they would expect, including negative surprises. Note that managers are also miscalibrated on the upside. Though I won't talk about upside miscalibration today, it's worthy of considering the ramifications of not fully anticipating upside opportunities. So, if we have a short planning horizon and experience frequent negative surprises, how might corporate policies be designed? Relative to a well-calibrated world with forecasts reliable far into the future, we might expect corporate policies that appear to be conservative, which is the third theme of the practice of corporate finance. Now let's talk about investment and capital budgeting, our second set of corporate policies and decisions. In this section, we'll explore how investment relates to the themes of corporate finance shown in bold. In particular, we'll see how capital budgeting relates to a near-term focus and conservative, sticky, simple decision rules. We'll also see that investment hurdle rates are not interest rate sensitive. And, as discussed in the paper, the survey documents the state variables that CFOs say drove investment outcomes in 2019, namely cash flows and demand, information that might be helpful for those modeling corporate investment decisions. To start our capital budgeting analysis, I asked CFOs which capital budgeting techniques are most important at their firms. This graphic presents results for large firms only, that is, firms with sales greater than $1 billion. I'll verbally mention small firms later. This graphic shows the percentage of CFOs who said that a particular decision rule is important or very important at their firms. For example, in 2022, shown in blue on the graph, we see that more than 3/4 of firms say that NPV and internal rate of return are important capital budgeting techniques. In orange, I've repeated the results from Graham and Harvey 2001 to allow us to determine whether the practice of finance has changed much in the past 20 years. Looking at the four most popular decision rules, we see a great deal of similarity between 2022 and 2001. This is evidence of stickiness or stability in decision-making, which is the fourth theme of real-world corporate finance. In fact, if you had asked me 20 years ago to make one prediction about capital budgeting, I would have predicted that, given its well-known shortcomings, the payback method, number 4 on the chart, would have grown much less popular by today. Instead, if anything, payback is more popular today, even among large firms. Number 5 on the list of methods is return on invested capital, which is also more popular today than an accounting rate of return was 2 decades ago. Notably, both payback and ROIC are simple decision rules, which is consistent with our fifth theme of corporate finance. Finally, payback and ROIC also both focus on the near term. For example, ROIC is often based on current information. And so capital budgeting methods also provide evidence of the first theme of corporate finance, near-term focus. Small firms are not shown on this chart. Most of the tables and figures in the paper contain separate columns for small firms, which at times provide interesting contrast to large firms and which may be worthy of future research exploration. For small firms, payback is the most popular decision criterion, much more so than NPV or IRR. This again is evidence of the pervasiveness of simple decision rules. In written comments, CFOs indicate that payback is popular due to constraints on funding, personnel, and time, as well as a lack of sophistication in the finance function. Discount rates and hurdle rates are another important part of capital budgeting. The blue line at the top of this chart shows hurdle rates going back to the mid-1980s. The 3 earliest results are from other surveys, while the 5 most recent results are from the Duke CFO survey. The rightmost blue square shows hurdle rates of about 15% on average from the 2022 survey. Interest rates are also shown in the black lines at the bottom of the graph. One immediate takeaway from this chart is the stickiness of hurdle rates over the last 35 years. As market interest rates have fallen by 8 or 10%, hurdle rates have only fallen by about 2%. This lack of interest rate sensitivity of hurdle rates suggests that corporate investment is not interest rate sensitive, an issue investigated by Sharp and Suarez. Another implication is that if hurdle rates do not change much through time, then dynamics of corporate investment are more likely driven by variation in cash flows, an implication that's consistent with the relative importance of the state variables driving investment that I briefly mentioned earlier. The weighted average cost of capital is also shown on the chart in orange. We can see over the past 20 years at least, companies have set their hurdle rate about 6 percentage points above their cost of capital. This is evidence of conservative decision-making, the third theme of the practice of corporate finance. Having a conservative buffer of 6% makes sense in a world where we can only plan a couple years into the future and we experience frequent negative surprises. With this buffer, when a negative surprise does occur, then ex post, our project may still earn positive NPV, reducing the odds that we'll be faced with the prospect of canceling an ongoing project. Now let's talk about capital structure. Again, as indicated in the bullets, the paper has quite a lot of information on capital structure, a subset of which we'll discuss today. Today, we'll connect several aspects of capital structure to the bold themes shown on this slide. In particular, we'll talk about near-term focus in how companies measure leverage, conservative and sticky capital structure policies, and attempts by managers to time the market. Also, at the bottom right, we see that debt decisions appear to be interest rate sensitive, contrasting with investment, as we just discussed on a previous slide. Let's start with the basic question of how companies measure leverage when they're evaluating their own use of debt. You can see from the chart that debt to EBITDA is by far the most popular method to measure debt. This chart shows the primary metric that firms use, while this chart adds the secondary and tertiary measures. This information is just for large firms, and for large companies, credit ratings come in second to debt to EBITDA, followed by interest coverage. For small firms, which are not shown on this graph, credit ratings are not important, and interest coverage becomes the number 2 debt ratio measure. Now, this is pretty interesting because as researchers, we overwhelmingly rely on debt to value and debt to assets to measure debt usage. In fact, about 90% of recent Journal of Finance capital structure papers rely on some version of these variables. Future research should investigate whether the particular debt variable we study affects our research conclusions. Also worth noting is that 2 of the top measures of debt are based on near-term cash flows, notably different than the denominator of debt to value and some other debt variables. And so, relative to how we might traditionally model things in our research, we observe evidence of a near-term focus in corporate decision-making, the first theme on our list. Finally, the top 3 debt measures all focus on ability to service debt, consistent with conservative capital structure focus, which is our third theme. The survey also explores whether companies have target debt ratios. Over on the right, if we add the orange and the yellow, we can see that in 2022, 60% of large companies say they have a strict or somewhat tight target debt ratio or target range. This is remarkably similar to what Cam and I heard in 2001. So with respect to the process related to debt targets, there's quite a lot of stability among large companies over the last 2 decades. Again, evidence of theme number 4, stickiness in decision-making. When I ask CFOs about the numeric targets for their debt ratios, analysis in the paper shows that companies rarely change their numeric targets within a decade-long time frame, though it's possible there's more variation over periods longer than 10 or 20 years. Also, in terms of what companies might mean by a target debt range, you can see at the bottom of the slide that among companies that rely on debt to EBITDA, their current debt ratio was 3.3, and around that they set an upper bound of 4.1 and a lower bound of 1.9. I should note that the paper discusses how to think about these results in the context of traditional models and also in the context of transitory debt. Now, small firms are not shown in this graph. The debt targeting behavior of small firms in 2001 was very similar to that shown for large firms. In contrast, today, small firms are different than large firms. Small firms today pursue a much more flexible capital structure. This again highlights interesting differences between small and large companies in the modern setting. As an aside, Mark Leary and I studied cash management practices going back into the 1920s. When you look at small firms in the 20s and 30s, they seem to operate, at least in our setting, as if they were mini large firms. What we're seeing today may be different. The small firms of today do not appear to operate as mini large firms to the same extent. As today's small firms grow, it will be interesting to see whether their decision processes also change to become more similar to how large firms operate, or whether instead small companies retain their current processes, possibly changing the practice of corporate finance in the future. Next, let's examine what drives debt policy decisions. Again, this may be a familiar-looking graph, given that it repeats the Graham and Harvey results from 2001 in orange. In blue, we have for large firms the debt policy factors that are important or very important in the year 2022. The first takeaway from this graph is the great similarity in the ranking of what's important in debt policy decision-making comparing today to 2 decades prior. Again, this is evidence of theme number 4, stickiness in corporate decision-making. Now, one advantage of this stickiness is if you haven't updated your teaching slides in the past 20 years, you're not too far out of date. That's an attempted joke, and that'll be my only attempted joke today. A second takeaway from this graph is that we can again see evidence of theme number 3, conservative decision-making. I say this based on the importance of preserving financial flexibility, which is actually quite a bit more important today than it was in 2001. In fact, flexibility is now more important than our credit ratings for large firms. I asked a separate question on the survey about what companies mean when they say financial flexibility is so important. There are 2 key elements. CFOs say that preserving investment opportunities is important, as is avoiding financial distress. Avoiding distress aligns with the conservative nature of capital structure objectives, our third theme. Next, the third-ranked item on this graph of factors that CFOs say drive debt decisions is the level of interest rates. This suggests market timing objectives consistent with theme number 6. This also implies that debt policy is interest rate sensitive, which contrasts with the investment conclusion we discussed earlier. More on interest rate sensitivity later. Now, there is one factor that's changed quite a lot from 2001. 20 years ago, 60% of large firm CFOs listed interest tax savings as one of their primary capital structure objectives. Today, tax deductions are in the second or third tier of debt factors, with about 25% of companies listing tax incentives as a priority. This makes sense because corporate income tax rates have fallen from 35% down to about 21% as of today. And interest rates are also low, so it makes the tax savings from interest deductions very small and therefore logically less of a focus in today's world. Also, the fact that the importance of the tax factor has changed in a way we would expect lends credibility to the stickiness or stability of the non-tax factors shown in the graph. On to payout policy. The payout analysis provides information that payout is conservative and sticky in that the decision process has not changed much in recent decades. Down at the bottom, a particular focus in the payout section is whether payout competes with or even crowds out corporate investment. There are 3 sets of analyses exploring this issue in the paper. For example, one analysis asks CFOs, what rate of return would investment have to earn to justify shifting funds away from payout to investment? Nearly a 20% after-tax return. Today, I'll show you one graphic about payout potentially competing with investment. I asked CFOs directly how their firms prioritize capital allocation of funds. This graph is just for dividend-paying firms. Among dividend payers, we see that maintaining the historic level of dividends is every bit as important as funding existing capital spending, and a little more important than funding new capital spending. In addition, increasing dividends is solidly in the next tier of priorities. So in this sense, according to CFOs, dividends do compete with corporate investment. In a separate analysis not shown here, just for repurchasing firms, CFOs say that share buybacks rank just a little bit lower than investment. Now, as with all survey research, these findings need to be analyzed in more detail with archival data and other research. But the takeaway here is that we need to think about historic payout and increases in payout as being roughly on par with corporate investment as we analyze the overall corporate objective function. A final set of analyses studies how companies think about their common stock and the goal of the firm. In this part of the paper, we find evidence of sticky and simple decision rules and managerial attempts to time the market. In terms of stickiness, stock issuance decisions and cost of equity estimation are implemented very similarly to 2 decades ago. Companies also rely on simple rules as they value their own stock and estimate its cost. Interestingly, the paper contains some data back into the 1990s that shows that most firms think in most years their stock is undervalued, which of course provides market timing incentives. The survey also contains new analysis about shareholder versus stakeholder focus. This graph shows that there's been a shift towards more stakeholder focus, according to CFOs. In orange are the results from a 2010 survey that asked, on whose behalf should a company be run? The online survey has a slider, and the CFO would pull the slider all the way over to 0 if they believed a company should be run on behalf of just shareholders. At the other extreme, if they believed a company should be run on just for other stakeholders, not counting shareholders, they would answer 100 over on the far right. As you can see in orange, in 2010, there was a distinct lean towards maximizing shareholder value as the goal of the firm. In 2022, the blue bars show that today there's a more balanced shareholder-stakeholder view, though there's still a little lean towards shareholders. The survey digs into related issues and asks which stakeholders companies focus on besides shareholders, as well as listing a number of questions for future research about how authentic is this shift towards stakeholders and what are the implications if it is an authentic shift. Okay, let's summarize. This paper gathers information from the expert practitioners who choose the outcomes that we study in corporate finance. This information reveals a number of stylized facts about practice and also documents common elements of the decision-making processes that hold across different policies and through time. Understanding well the practice of finance can be useful in several ways. First, if models predict outcomes well, then knowledge about practice can help us understand the mechanisms at work. Second, to the extent that models and outcomes do not align, then knowledge about practice helps us determine whether practitioners are at fault, models are at fault, or both. If practitioners are at fault, knowledge about practice helps researchers identify whether practitioners make correctable mistakes. And if they do, what are the consequences of those mistakes? And if those consequences are large, how can we correct the mistakes to improve practice? This practice-grounded sequence of research steps can lead to research and teaching that guides and improves practice. It's an interesting question, though, that if managers make large mistakes, why have not market forces already corrected those mistakes? This leads to another possibility, that models may be at fault. In this case, knowledge about practice provides new information to enhance academic modeling efforts. In all of these scenarios, starting with clear knowledge about the practice of corporate finance grounds research in ways that has a clear connection to practice and therefore hopefully is beneficial to research, practice, policy, and teaching. There are three broad categories of results in the paper. First, with respect to corporate expectations and planning, we learn that managers are miscalibrated and focus on the near term. The paper also explores how firms react to forecast error and the effects of forecast error on real decisions as well as future forecasts. My hope is that future research will explore the dynamics of corporate planning and how planning interacts with corporate policies. For example, planning produces the revenue and cash flow forecasts that underlie other corporate policies, such as investment. So connecting planning to other corporate decisions seems to be a fruitful area for future research. A second set of results identifies the objects that companies prioritize in their corporate objective functions. According to CFOs, there's been a shift towards a more balanced shareholder-stakeholder emphasis. Other findings highlight just how important revenues are among corporate objectives. Also, companies measure capital structure with debt to EBITDA, and in capital allocation, payout rivals investment. Future research should consider these and other corporate priorities identified in the paper to determine whether the implications of research change along with these priorities. The third set of results, and really the organizing principle of the paper, provides detailed information about capital structure, capital budgeting, and payout. And in the process, the paper identifies common practice of finance themes that cut across corporate policies and hold through time. My hope is that this collection of results can guide and discipline academic models and empirical tests of corporate finance to improve our ability to predict and explain real economic outcomes, and in the process, begin to close the gap between academic research and the practice of finance. These common themes of corporate finance may be of independent research interest, posing questions such as, which underlying forces cause these themes, and why do the themes persist? How do the various themes interact and coexist? Are some of the themes more fundamental, and they in turn cause other themes? Secondly, the themes provide for a wider range of more realistic assumptions that may enhance existing models, as well as potentially lead to a broader set of models that have the potential to better explain outcomes and improve predictability. We talked about how the themes might be integrated into traditional models. Alternatively, one might take the themes of corporate finance as given and try to determine whether there's a rational or behavioral model that's consistent with the observed practice of finance, in the process being careful not to model mine. We also discussed how the themes might lead to non-traditional models, such as satisficing with incremental improvement. I argued earlier that a satisficing behavior paradigm with one step ahead incremental improvement and very local optimization nests many of the themes. We can also consider other behavioral models as well as the interdisciplinary aspect that finance is often a support function to other managerial objectives. The results of this paper have implications beyond corporate finance. The CFOs and companies we've been talking about, they hire the employees and they build the assets that produce the cash flows and the value that, when you aggregate it up, define the macroeconomy. So better understanding corporate finance seems important to understanding certain macroeconomic issues. On the policy side, the sticky hurdle rate with conservative buffers that we talked about earlier make it difficult for monetary policy to move the needle on investment. So we may need other sorts of policies beyond monetary to spur investment when that's the objective. Related to this, we noticed a potential tension between capital structure being very interest rate sensitive and investment not being interest rate sensitive. It'll be interesting to study the implications of how these results coexist, given that we think of investment and debt usage being so closely intertwined. Finally, what about asset pricing? As mentioned earlier, the managers and companies that follow the themes of corporate finance, they ultimately produce the cash flows upon which asset prices are based. So again, there's a connection between the practice of corporate finance and asset pricing. One interesting item is that I argued earlier that precisely estimated discount rates or hurdle rates are unlikely to explain the dynamics of corporate investment. Instead, investment dynamics are probably driven more so by cash flows and demand. At the same time, investor discount rates are thought to be very important in asset pricing. It may be interesting in future research to consider the interplay between these two phenomena, as well as other interactions between corporate finance and asset pricing. Well, that's it. Thank you for listening, and if you're so inclined, I hope you enjoy reading the paper. I'll close by showing a list of survey partners I worked with to conduct the global surveys behind this project. Thank you.
Thank you, John, for such a fascinating talk. We very much appreciate your service to the American Finance Association. The energy and dedication you have put into improving the organization has been frankly amazing. Congratulations on now being a fellow of the American Finance Association.
Thank you, Laura. Needless to say, it's been a tremendous honor to serve the AFA in this capacity. And now, Laura, I'd like to welcome you as the incoming president of the American Finance Association. The AFA will be in good hands, and I look forward to continuing to work with you in the coming year. At this time, let me symbolically pass to you the gavel, and thank you again.
Thank you, John. We look forward to seeing everyone in person next year in New Orleans. The business meeting is hereby closed.